Hello, everyone. I'm Guanming from the Durham University. It is a great pleasure and honor to present at this 2025 International Conference on Financial Technology and Business Analysis. Today, I will be discussing strategies for mitigating corporate social irresponsibility and promoting corporate social responsibility. My presentation will cover the following topics: the concept of the corporate social responsibility and its implication for firm performance, the causes and consequences of corporate social irresponsibility, strategies for mitigating corporate social irresponsibility and fostering value enhancing corporate social responsibility. And finally, the role of corporate governance in supporting these efforts. Well, corporate social responsibility reflects the degree to which managers and shareholders consider the interests of current and potential outside stakeholders, as well as broader societal concerns. To be socially responsible, a firm must actively support environmental sustainability, social welfare, and sound governance practices. Good CSR performance can enhance corporate reputation and strengthen the relationship of the firm with the business stakeholders. Corporate reputation is an essential intangible asset conducive to a firm's competitive advantage. A good reputation due to the corporate social responsibility will signal the firm's ability and commitment to work in the interests of the stakeholders, and thereby increases the firm's creditworthiness to the stakeholders. And this um, will in turn contribute to um, the societal legitimacy and a solid contractual relationship or tacit agreement with the firm's business stakeholders. And these stakeholders will in turn have more favorable attitude towards the firm and be more inclined to supply their resources and support to the firm. Good relationship with broad stakeholders facilitate information communication between the firm and its stakeholders and enable the firm to derive more external knowledge, spurring its innovation potential. And from another perspective, better communication between insiders and outsiders will reduce the information asymmetry, mitigating the conflict of interest between the managers, the companies, and its stakeholders. In all, engaging in CSR, the corporate social responsibility, can enhance a firm's reputation, improve long-term profitability, and ultimately contribute to greater shareholder value and firm value. However, the benefits of the corporate social responsibility are not uniform across different firms. These benefits tend to be more substantial for larger and more highly visible companies. In the meantime, there are costs associated with environmental, social, and governance investment and operations, especially in the context of the long-term sustainable development goals. There has been considerable debate regarding whether corporate social responsible behaviors will violate the maximization of the shareholders' wealth. Conventional wisdom argues that the priority of a firm is to generate profits for its shareholders. Using limited corporate resources to perform corporate social responsible activities will generate unnecessary costs and um, consume the resources that could be invested alternatively in value-enhancing investment and operation activities. Likewise, if a firm has the resources, the firm should distribute these resources in the form of the dividends to the shareholders, for example, rather than use these actual resources for the uh, corporate social responsible activities. This is because involvement in the socially responsible business activities will imply a transfer of wealth from the company's shareholders to the third party, the stakeholders, without rightful claims. And furthermore, involvement in the corporate social responsible activities can be time consuming and the resource consuming. Managers emphasizing the corporate social responsible uh, initiative too much may overlook their primary management responsibility or some profitable investment opportunities. And this seemingly inefficient resource allocation due to the CSR will be more evident when managers use the CSR engagement to burnish their reputation or to conceal some corporate wrongdoing or misbehaviors. And for financially constrained firms or those startup companies, the cost of making the socially responsible investment or operations may outweigh the potential benefits, making the CSR initiative and activities more burdensome and costly for these firms, uh, who by themselves will be relatively hard to survive and to develop. Um, and for this reason, investor attitude towards CSR can vary. Some may view it favorably, while others may see it as a costly distraction. And this perception depends not only on the anticipated cost versus benefits trade-off of the ESG effort, but also on the investor own commitment to social responsibility, which may be independent of profit motives. On the other hand, the firm can be behaving socially irresponsible to the stakeholders, as illustrated by a wide range of high-profile unethical or illegal ESG-related scandal. And these corporate socially irresponsible activities will definitely undermine the firm value. Specifically, these socially irresponsible activities will diminish the competitive advantage of the firm by eroding its relationship with its stakeholders. There's ample research evidence that reveals that the stakeholders' negative attitude towards and the strong intent to punish the unethical and socially irresponsible firms. Um, for example, the consumers are inclined to stop buying the products or services from the firm that behaves in a socially irresponsible manner and to spread negative word of mouth to a range of acquaintances to boycott the firm's products or services. In addition, the corporate social irresponsible behaviors also elicit the employees' anger, resulting in negative word of mouth among these employees. And these potential stakeholders' sanction or boycotts significantly limit the ability of a firm to achieve satisfactory financial outcomes. Well, the corporate social irresponsibility often stem from the manager short-termism or myopia. Um, they may have a narrow focus on the short-term immediate gains. At its core, the corporate social irresponsibility reflects the conflict of interest between the shareholders or managers acting on their behalf and various stakeholders. For example, the conflict between shareholders and suppliers may arise when firms pressure the suppliers for excessively low prices or extended credit terms, thereby undermining the supply sustainability. Conversely, tensions with customers occur when firms charge excessively high prices or impose restrictive credit terms. And similarly, conflicts between managers and employees can emerge when firms seek to minimize the labor costs while demanding increased productivity and commitments from the employees. In other words, the managers expect the employees to work as much as possible, but are not willing to pay the employees uh, in line with their contribution uh, to the company. In addition, the conflict also arises between the corporate managers and the broader society when firms neglect their social or environmental responsibilities, particularly when such stakeholders offer limited direct economic returns to uh, the business of the firm. So, the essential remedy to mitigate the corporate social irresponsibility is to figure out a solution to mitigating the conflict between the company's managers and the firm's stakeholders. Let's first look at the consequences of the CSR. This highlights the importance to curb any corporate social irresponsible activities. These socially irresponsible behaviors, especially when exposed by the media, will unambiguously lead to reputational losses and diminish a firm's long-term profitability. Um, and these socially irresponsible behaviors can result in legal penalties and reputational harm, thereby increasing the contracting costs, external financing costs, and elevating financial, operational, and information risks of the firm. While not all firms have the capacity or resources to engage intensively in socially responsible initiatives, as I mentioned earlier, all the firms are expected to refrain from pursuing socially irresponsible action uh, to the detriment of other stakeholders' interests. So, in general, market participants tend to place greater weight on the avoidance of corporate social irresponsibilities than on the promotion of the corporate social responsibility. And given the detrimental impact of the corporate social irresponsibility on firm value, investors typically react more unfavorably to the firms that involve in the CSI, the corporate social irresponsibility. So how can a firm mitigate the corporate social irresponsibility and promote the value-enhancing corporate social responsibility? Um, the possible strategies generally fall into two broad categories, two mechanisms. First is the monitoring and advising on the managers. Uh, Make them refrain from engaging in the corporate social irresponsible activities. The second mechanism is to provide compensation incentives for the managers who act on behalf of the shareholders. Let's talk about the first mechanism, the monitoring and advising. Under this mechanism, firms can implement effective ESG risk control system, achieve a good trade-off between the costs and benefits of investing in social capital, and makes the benefits outweigh the costs, not only through enhancing public awareness of the CSR commitments, but also by strengthening marketing and innovation capabilities. And firms with strong marketing and innovation performance are better positioned to gain support from the external stakeholders. In other words, if the company are well performing in marketing and innovation, they will have a strong, sustained competitive advantage in the long term. So it will be relatively easier for this firm to attain the support from the stakeholders. So it's worthwhile for this firm to invest more in the socially responsible initiative. Okay. So we can regard the marketing, innovation, and the CSR as the fundamental driver of the company's long-term sustainable development. Okay. So in the first place, the firm are expected to build up a strong marketing team and the innovation team. And in the meantime, the firm should treat the business stakeholders nicely, such that they can attain the support from the stakeholders when the company is in a bad state, when the firm is subject to some negative exogenous events. Okay. And finally, is the firm um, should strengthen the board level monitoring and advisory functions to manage the ESG risk and guide the managers towards value-adding social investment. The second mechanism involves aligning manager incentives with the long-term ESG and the firm value goals. This may include long-term incentives compensation plans that reward managers for maximizing shareholders' value and meeting specific ESG targets, such as stock options with long vesting periods, restricted stocks, performance shares, or cash stock sector performance units. The other compensation is the debt-like compensation in the form of pension or deferred compensation. And this type of the compensation will discourage the managerial misconduct by increasing their personal exposures to downside risk associated with the corporate social irresponsible activities. Okay. So put in this way, if the firm engage in the corporate social irresponsible action, the loss in the reputation and the shares of the litigation will increase the default risk of the firm. If a firm face high default risk, then those managers holding a large pension or deferred compensation will have the risk of not being able to get back the full amount of their pension and deferred compensation at a faraway future point, say at the time when they retire. So they tend to avoid the risk if they hold a large amount of the pension or deferred compensation. Okay, so this is why this type of the compensation can make the managers be prudent in engaging in these corporate social irresponsible activities. Relatedly, how does corporate governance mitigate the corporate social irresponsibility and promote value-enhancing corporate social responsibility? Um, the key is to build up a strong corporate governance. Okay. Because if a firm engage in corporate social irresponsible actions, in the long term, the shareholder value will be undermined. Okay. And the purpose of building up the strong internal governance is to align the interests of the managers with the shareholders, not only for the short term, but also for the long term. Okay. So from a long-term perspective, the strong internal governance need to design in a way that um, first promotes the high quality of the financial reports. So why this matter? This is because only under very transparent financial reporting and disclosures can the stakeholders better monitor and advise on the managers. Okay. To avoid the managers engaging in any socially irresponsible actions to the detriment of the stakeholders. Okay. Um, the second way of strengthening the internal governance is to design a reasonable incentives compensation. There are three compensation incentives for the managers. Okay. The first is the long-term equity compensation incentives. The second is the long-term cash incentives. The third is the long-term debt compensation incentives. All these type of the compensation will incentivize the managers to pursue actively the value enhancing socially responsible business activities. Okay. Uh, Another additional way of mitigate the corporate social irresponsible action and to promote the CSR is to enhance the monitoring on the CSI, okay, and advise on the value enhancing CSR, okay. Uh, but the cost for the board of directors to play this role will be high, okay, relative to the incentives compensation. Okay, the purpose of the incentives compensation is to align the manager's interests with the not only the shareholders' interest but the stakeholders' interest for the long term. Okay, so in this case, the conflict of interest between the shareholders and other stakeholders will be minimized. Okay, for the longer term. Okay, so this is the best for the firm to mitigate the CSI and promote the CSR. Okay, but complement to the incentives compensation, the board of directors can continue to take effort in monitoring the firm managers. Okay, on the one hand, um, to oversee managers for any corporate social irresponsible action, and on the other hand, advise how the managers can take care of the interests of the business stakeholders. Okay. What you see in this graph regarding the promotion of high quality financial reporting and disclosure and the promotion of the incentives compensation are relatively less costly way to use the corporate governance to mitigate CSI and promote CSR. Okay. On top of the traditional way, that is to enhance the role of the board of directors in monitoring and advising on the managers. Okay, so that's it for my presentation. Thank you for listening. If you have any questions or comments, welcome to email me. I'm more than happy to discuss them with you. Um, I also look forward to the opportunity of interacting with you on these very important topics. Okay, we know much about the corporate social responsibility versus corporate social irresponsibility. Okay, now the issue facing us is how to promote okay the CSR better to curb the CSI. I just give a sort of generic guidance on how to achieve so. Okay. Um, More insights and the research um, are needed. Okay, um, to move forward this important area of the research. Okay, thank you.